Today we are taking a closer look at an important monetary policy concept that continues to generate discussion among followers of Iraq's financial reforms. Our focus is on a statement originally published in 2021 by financial advisor Salih, who previously served as a senior official at the Central Bank of Iraq under former Governor Sinan al-Shabibi. Although these remarks were made several years ago, they continue to be referenced because they explain the theory behind monetary reform, currency redenomination, and the possible coexistence of old and new banknotes during a transition period. As always, our goal is to analyze these concepts objectively, explain what they mean in practical economic terms, and separate established monetary principles from speculation. The statement discusses how monetary systems attempt to remove the burden of historical inflation by deleting 3 zeros from a national currency. This is an idea that has been implemented in many countries throughout history. It is important to understand exactly what this means, because the phrase, deleting 3 zeros, is often misunderstood. In economic terminology, deleting 3 zeros does not automatically mean that people become wealthier overnight, or that a country's purchasing power suddenly changes. Instead, it is primarily an accounting and currency management process that simplifies transactions by replacing large numerical values with smaller ones, while preserving the same underlying economic value. To better understand the concept, imagine a situation where a person holds a 25,000 dinar banknote. Under a redenomination process that removes 3 zeros, that old note could eventually be exchanged for a new 25 dinar note. The key point emphasized by Salih is that both notes would represent the same purchasing power. Nothing has changed regarding the owner's real wealth. The only difference is that the numbers printed on the currency become small and easier to use. This distinction is extremely important because discussions surrounding the Iraqi dinar often confuse redenomination with appreciation or changes in exchange value. In reality, these are two completely different monetary concepts. A redenomination changes the numerical scale of the currency, whereas a revaluation or appreciation involves a change in the exchange rate relative to foreign currencies. One process is largely administrative, while the other reflects broader economic and exchange rate policy decisions. Salih's explanation specifically mentions that monetary systems seek to eliminate the burden created by historical inflation. This phrase deserves careful attention. Countries that have experienced prolonged periods of inflation frequently end up with currencies requiring increasingly larger numbers to conduct ordinary transactions. Instead of paying 25 units for a purchase, consumers may eventually pay 25,000 units or even millions of units if inflation becomes severe over many years. Large numbers complicate accounting systems, banking operations, government budgeting, software infrastructure, pricing labels, and everyday commercial transactions. When inflation is eventually brought under control, governments sometimes choose to simplify the monetary system by introducing a redenominated currency. Instead of carrying around notes with multiple zeros, citizens begin using smaller numerical denominations that are easier to understand and manage. One of the most interesting parts of Salih's statement is his reference to the coexistence of two currencies with the same value. This concept has appeared in numerous international monetary reforms and is generally considered a practical transition strategy rather than an unusual event. During such periods, old banknotes remain legal tender while newly issued notes gradually enter circulation. Banks exchange the old notes for the new ones over a defined timetable, allowing businesses and consumers to adapt without disrupting economic activity. The coexistence period helps reduce confusion. Rather than forcing everyone to exchange all their money immediately, authorities provide sufficient time for households, businesses, retailers, banks, and government institutions to transition smoothly. This minimizes operational risk while maintaining public confidence in the currency. The important phrase in Salih's explanation is the same value. That means if both currencies circulate simultaneously during the transition, they are simply different versions of the same monetary unit. One is expressed using larger numerical values, while the other uses smaller numerical values. Their purchasing power remains equivalent, according to the officially established conversion ratio. This principle is common in redenomination programs because governments want to reassure citizens that their savings are protected. Public confidence is essential during any monetary reform. If people incorrectly believe that changing the appearance or denomination of banknotes reduces their wealth, confidence in the financial system could weaken. Therefore, monetary authorities consistently emphasize that redenomination does not reduce purchasing power when implemented correctly. The article also refers to maintaining the same value against a foreign currency, such as the US dollar. This statement reflects another important monetary principle. During a redenomination, authorities generally establish an official conversion ratio so that both domestic and international values remain mathematically consistent. If an exchange rate existed before redenomination, the numerical exchange rate would also be adjusted proportionally to reflect the new unit of account. This ensures continuity in trade, banking, accounting, and international financial reporting. From an economic perspective, this process helps avoid confusion for importers, exporters, investors, commercial banks, and government agencies. Financial contracts can be converted systematically according to the official redenomination formula without changing their underlying value. The article further suggests a transition from large 3-0 notes toward much smaller denominations, possibly including notes below 100 and even coins. This observation reflects another characteristic frequently associated with stable monetary systems. When inflation remains low and prices become more stable, smaller denominations regain practical usefulness. In high inflation environments, coins often disappear from circulation because their purchasing power becomes insignificant. Producing them may even cost more than their face value. However, when inflation remains consistently low, coins can once again facilitate everyday transactions involving relatively small purchases. Likewise, lower denomination banknotes become practical because prices are no longer increasing rapidly. Instead of requiring large value notes for ordinary purchases, consumers can comfortably use smaller denominations for routine transactions. The article references an inflation rate of approximately 3%. While inflation levels naturally fluctuate over time, the underlying economic principle remains valid. A stable and relatively low inflation environment provides a much stronger foundation for considering any future redenomination. Monetary authorities generally avoid redenomination during periods of uncontrolled inflation because rapidly rising prices would quickly recreate the very problem the reform intended to solve. Price stability is therefore one of the most important prerequisites for successful monetary reform. Stable inflation encourages consumer confidence, supports predictable business planning, improves investment conditions, and strengthens the credibility of the central bank. For Iraqi Dinar followers, this historical article offers insight into how senior policymakers have viewed monetary reform conceptually. It illustrates that discussions about deleting 3 zeros were framed as technical monetary policy, rather than as promises of immediate wealth creation. The emphasis was on simplifying the monetary system after achieving sufficient economic stability. This distinction matters because monetary reform should always be analyzed within the broader framework of macroeconomic policy. Currency structure is only one component of a nation's financial architecture. Sustainable economic strength depends on many additional factors, including fiscal discipline, diversified economic growth, banking sector modernization, foreign exchange reserves, institutional credibility, political stability, effective governance, and confidence among domestic and international investors. Iraq has spent many years implementing reforms across several of these areas. Banking modernization, electronic payment systems, anti-money laundering compliance, digital financial services, customs modernization, financial transparency, and improvements in government revenue collection have all been discussed as components of broader economic development. These reforms collectively aim to strengthen the financial system, regardless of whether any future currency restructuring occurs. Another important point is that monetary policy decisions are generally made according to national economic conditions rather than public expectations. Central banks carefully evaluate inflation trends, money supply, banking liquidity, payment infrastructure, foreign reserve adequacy, exchange rate stability, and financial market confidence before considering significant monetary changes. Because of this, historical articles should be viewed as explanations of policy principles rather than indicators of specific implementation dates. Financial professionals typically distinguish between describing how a monetary system works and announcing that a policy will occur imminently. Those are very different types of communication. For long-term observers of Iraq's economy, Salih's comments remain relevant because they describe the theoretical design of a redenomination process. They explain why two currencies might temporarily circulate together, why purchasing power remains unchanged during conversion, and why lower inflation supports the practical use of smaller denominations. This also helps clarify why deleting zeros is fundamentally different from inflation itself. Inflation changes purchasing power by increasing prices over time. Redenomination changes numerical presentation without necessarily affecting purchasing power. The two concepts should never be treated as interchangeable. International experience demonstrates that countries implementing successful redenominations generally combine them with broader economic reforms. Currency changes alone cannot solve structural economic challenges. Strong institutions, disciplined fiscal policy, efficient banking systems, productive investment, diversified industries, and public confidence all contribute to long-term monetary stability. For Iraqi businesses, a simplified currency could potentially improve accounting efficiency, reduce calculation errors, streamline software systems, simplify bookkeeping, and make pricing easier to understand. Banks could process transactions more efficiently, retailers could update price displays more easily, and financial reporting could become less cumbersome. Consumers might also benefit psychologically from dealing with smaller numbers in everyday transactions. Although this does not increase purchasing power, it can improve the overall usability of the currency. International investors often pay close attention to institutional stability rather than merely currency denomination. Predictable monetary policy, transparent regulation, reliable banking supervision, and consistent economic reforms typically carry greater weight than the number of zeros printed on banknotes. In the short term, historical explanations like this mainly contribute to public understanding rather than indicating immediate policy changes. They help clarify how monetary authorities think about currency management and why certain reform proposals have been discussed over the years. Over the longer term, if Iraq continues strengthening its banking sector, maintaining reasonable inflation, improving financial governance, expanding non-oil economic activity, and reinforcing institutional credibility, the country could have greater flexibility in managing future monetary reforms. However, any such decision would remain subject to official policy announcements and prevailing economic conditions at the time. For followers of the Iraqi dinar, the most constructive approach is to evaluate developments through official statements, economic indicators, central bank communications, government fiscal policy, inflation data, and broader macroeconomic trends. Individual historical articles can provide valuable educational context, but they should not be interpreted in isolation or as definitive evidence of future policy actions. It is also worth remembering that modern central banking places considerable emphasis on communication. Monetary authorities understand that confidence is one of the most valuable assets within any financial system. Clear explanations of policy objectives help reduce uncertainty and support orderly financial markets. Salih's remarks reflect this educational approach. Rather than focusing on speculation, they explain the mechanics of monetary reform, the logic behind redenomination, and the importance of maintaining equivalent value during a currency transition. These are concepts recognized within monetary economics and have been observed in multiple countries that have restructured their currencies after achieving greater economic stability. Ultimately, the article serves as a reminder that successful monetary reform is rarely a single event. It is usually the culmination of years of economic stabilization, institutional development, banking reform, prudent monetary management, and careful planning. Currency design is only one visible component of a much larger economic framework. As Iraq continues pursuing economic modernization, observers will likely continue monitoring developments in banking, public finance, exchange rate management, inflation, foreign reserves, digital payments, and regulatory reforms. Together, these indicators provide a more complete picture of the country's monetary trajectory than any single historical statement alone. Thank you for watching today's analysis. If you appreciate responsible, factual, and balanced coverage of Iraqi dinar developments and Iraq's evolving economy, please subscribe to the channel and like the video so you don't miss future updates. We remain committed to presenting information in a professional and evidence-based manner, focusing on economic fundamentals rather than speculation. As always, this content is provided for informational and educational purposes only, and should not be considered financial, investment, or trading advice. Always conduct your own research and consult qualified financial professionals before making any investment decisions.